Thank you all for joining this Blockchain Coinvestors webinar. My name is Topher Nelson, and I'm the head of digital asset research at Blockchain Coinvestors. And it is my pleasure to welcome you all to the Q2 2025 edition of our biannual digital asset regulation report, which tracks the global crypto regulatory landscape. And this past year and even the past 3 to 6 months have been incredibly busy and seen incredible progress. So we really couldn't be discussing this topic at a better time. Now, we are a fund manager, so I do have to show you this disclaimer. Today's webinar is meant to be purely educational. Nothing mentioned here should be construed as investment advice, and you should always do your own research. If you are interested in learning more about our funds, you should reach out to us directly and rely only on the primary fund materials, which we'll be happy to share. And this is who we are. It's been about 10 years since we pivoted to be focused on blockchain investing, and we're a specialist asset manager purely focused on blockchain. We manage 7 funds, which give us the exposure shown on the bottom row here. And as of today, we are super proud to say we have capital deployed across more than 1,250 blockchain companies and projects around Europe, North America, and Asia, including 110 unicorns valued at over $1 billion, which is just remarkable by any metric. And you'll see their logos on the following pages. And about 50% of the capital we invest is in Europe and Asia, giving us global coverage, which reflects the global nature of Web3 itself. And all in all, we're very proud of these metrics. We believe they really speak for themselves. And this is the investment thesis our founding partners wrote down almost 10 years ago now. And while the pace of blockchain adoption in the meantime has surprised even us, the core themes of our thesis here remain largely unchanged in the past 10 years. These facts were true 10 years ago, they're true today, and they'll still be true 10 years from now, really because we're in the middle of a very substantial transformation. Just as communications and content went digital over the past 30 years, the future of finance is also digital. And the digitalization of commerce and finance, which is being enabled now by blockchain technology, will be the greatest value creation event some of us will see in our lifetimes. And for about the past 10 years, actually, we've been putting out a detailed webinar on our investment thesis, so I won't spend too long here today. But if you're curious why we have such high conviction in our thesis and essentially how we know what we know, I really recommend checking that out after. Our goal, which you can see here, is quite simple. It's to provide our investors with a simple value proposition that a single investment can be made to get global, diversified exposure to hundreds of the world's best early-stage blockchain companies and projects, all on an institutional platform. And this is something we think no one else in the world can offer you today in the way that we can, particularly with the global coverage, which is absolutely critical in this industry. And as I mentioned before, these are the logos of the 110 plus blockchain unicorns we're invested in. And some of these will be household names to you. And this list includes both traditional private equities and investments into traditional companies like Chainalysis and Ledger, for example, which sell compliance software and hardware wallets. But it also includes early stage tokens like Bitcoin and Ethereum, and tokenized projects like Filecoin, really spanning the entire blockchain digital finance ecosystem. So it's a very diverse group, but all of them valued at over $1 billion, and we're very excited to be investors in each of them. And all of them are helping us move toward what we've termed digital finance, which essentially represents the core intersection of a variety of key innovations, including fintech, blockchain, and now AI at the center here. And this essentially means financial products which are accessible, secure, trusted, frictionless, and fast. And we think this is the future. And the upgrading of the world's financial infrastructure to natively digital finance is going to be one of the greatest value creation opportunities in history, particularly for savvy investors. As part of our efforts to keep our LP community up to date on the latest developments and keep our investment strategy up to date, we put out 3 biannual research reports, which are featured now in a handful of publications. Today's webinar, of course, marks the 5th edition of our biannual digital asset regulation report, which tracks the state of blockchain and crypto regulatory progress around the world. In January and July, we published our Meet the Blockchain Unicorns report, which tracks early stage value creation in Web3 and represents the world's most comprehensive database of blockchain unicorns available today. And altogether, we think these three reports give any prospective investor in blockchain and digital asset a comprehensive foundation to at least approach the market. And all of these reports are available on our website at blockchaincoinvestors.com/either adoption, regulation, or unicorns. And you'll also find the sign up there for our next mid-year unicorns report, which you won't want to miss. So in order to assess the global regulatory landscape on an ongoing basis, we maintain a database of the world's top 25 financial centers, as determined by a variety of factors seen on the left here. And we diligently track their regulatory progress by stage, scanning news, media, pending legislation, national elections, and so on, to assess their progress all the way from initial leadership aspiration to actual implementation of legislation, as you can see on the right-hand side here. And so this is exactly how we organize the full tracker, which you'll see in the next few slides. And since the Bitcoin strategic reserve conversation has heated up in the past year, we've also included for the first time ever a state-by-state strategic Bitcoin reserve tracker, which follows basically the same format. But before we dive into the results, a bit on the demographics. Altogether, in looking at the world's top 25 financial centers shown on the left-hand chart here, our report covers a cumulative population of more than 267 million people in large-scale metro centers, with GDP per capita shown on the right here, ranging from $9,200 a year in US dollars on the low end to nearly $130,000 on the high end, and spanning 19 countries. So it's a pretty large and comprehensive swath of the world's most substantial economies included in the survey. And now to the results. What is the overall status of digital asset regulation globally? Well, digital asset regulation has entered a heightened acceleration phase around the world. Today, nearly all geographies have drafted, approved, or even implemented regulatory frameworks. And some, like Dubai and Zurich, have even gone as far to incorporate tailored frameworks for various DeFi activities or decentralized autonomous organizations. And most notably, the rapid reversal in US crypto sentiment and the newfound zeal from the administration is already driving global urgency to compete for digital finance innovation. And as the world's largest and most important innovation economy puts regulatory structure in place, the rest of the world will very quickly move to harmonize theirs in order to capitalize on US markets. And here the world map view of the results tell exactly that story. 2 years ago, this map was about half red, half yellow with very few green dots. Top tier jurisdictions at the time largely had no clear regulation in place or were openly hostile to the industry in many cases. Even at mid last year, this map was still predominantly yellow, with most geographies discussing early crypto regulation, but little regulation actually in place. Today, however, we are in a markedly different world, and for both the public and private market investors, this has some critical implications, which we'll discuss today. So without further ado, this is the official Q2 digital asset regulatory tracker, or the first page at least. And as you can see, the world is quickly moving to embrace digital finance. Europe's market and crypto asset regulation regime, or MiCAR, which has been in the works for nearly 3 years now, is fully implemented. Excluding China, Asia is a clear leader in digital asset regulation already and have been longtime leaders in the overall transition to digital, while the US sat almost entirely on the sidelines for the past 4 or 5 years. Zurich, Dubai, Tokyo, Singapore, Hong Kong, and London have all quickly become digital asset hubs. And here on the second page, we can see some of the laggards that are now working to catch up. The US obviously has come online only in the past 3 to 6 months, really, driven by the new Republican administration and vocal support from President Trump. In short succession, as a result, we've seen a variety of legislative work kick off, which we'll discuss in depth in the next few slides. And the US is essentially rushing to put rules of the road in place. China remains staunchly opposed to decentralized products that threaten central control, of course, but they've nonetheless advanced legislation, albeit quite stringent, and against what you might call the core ethos of crypto and decentralization. But in terms of central bank digital currencies, though, China is arguably the most advanced in the world, so it's a bit of a mixed bag. Crypto sanctions have also become a part of the sanction battle between the EU and Russia. Australia still intends to implement crypto legislation, but they've stalled a bit in the past year. And India, who looked like China for many years, mostly anti-decentralization, anti-crypto, and had kicked out a string of crypto companies the past year or two, is now showing early signs of a softening stance, and Coinbase is even considering re-entering the country finally. So you can download the full tracker on our website, so don't worry if you missed anything. But on the next few pages, we'll double click on a handful of key global regions and groups here to really understand what happened in Q1, but more particularly, why the investment landscape just got so much better. And first and foremost, the biggest news of Q1 obviously has been the rapid US entry into crypto driven by President Trump. So we'll spend a few extra slides discussing what just happened in the US, frankly, because the rest of the world looks to us for regulatory leadership in many ways. And the regulatory work in process now in the US has global implications. And I apologize somewhat insincerely for moving quickly, but arguably more has happened in the past 4 to 6 months than the past 4 to 6 years. So following his election and inauguration, Trump got right to work, and in January issued Executive Order 14178, entitled Strengthening American Leadership in Digital Financial Technology, which accomplished 4 key things. And this was the start of his real work and progress in crypto. First, it called out the need to rapidly revoke a whole slew of anti-innovation Biden-era policies that were a result of the anti-crypto army of Gary Gensler and Elizabeth Warren and operations like Choke Point 2.0. And essentially, it called to create a clean slate for crypto. Second, it prohibited the possibility of an Orwellian Fed-issued Fed coin or central bank digital currency in the form that we see it in China, which is, of course, fairly Orwellian. Instead, electing to allow for private sector stablecoins to lead. Third, it created a working group tasked to propose federal regulatory framework for crypto within 180 days, chaired by the world's first crypto and AI czar, David Sachs. And that group now has, I believe, under 100 days to deliver that. And fourth, it outlined clear policy objectives for the Senate and House leadership, including the specific legislation they should work towards and the deadline for each. And overall, it made it abundantly clear that federal agencies could not block and undermine innovation any longer. And the very same day, the SEC finally rescinded Standard Accounting Bulletin 121, which had effectively barred banks from custodying crypto assets in a relatively targeted effort specifically to stifle the industry. And throughout the next month, in February on to today, the SEC has dropped and quietly paused a whole string of prominent lawsuits, probes, and investigations into crypto companies now, who had spent hundreds of millions of dollars of their shareholder capital fighting those capricious cases, which in turn themselves had wasted hundreds of millions of taxpayer money. The FDIC, the Federal Deposit Insurance Corporation, also released documents under a Freedom of Information Act request in February, showing a very clear history of bad faith regulation. And now the debanking activities of multiple federal and state agencies are under review and being discussed in the House and the Senate. In March, Trump issued a second critical digital executive order, EO 14233, which formally established the U.S. Strategic Bitcoin Reserve and U.S. Digital Asset Stockpile, making the U.S. the first country to formally incorporate a Bitcoin strategic reserve into its treasury activities, as well as the second digital asset stockpile for holding other crypto assets. And essentially, the beginning of that process will be that all federal digital assets already held from seizures and raids and whatnot will be moved into these new venues. And perhaps this looks like more than 200,000 Bitcoins already, and other crypto assets, including holdings of Cardano, Solana, and XRP for starters. But even more dramatically is that the president also instructed his cabinet to explore budget-neutral ways to grow these reserves. And that's super interesting because under that mandate, you could even imagine something like auditing Fort Knox and then selling large quantities of gold and reinvesting the proceeds into Bitcoin and even other strategic crypto assets. So it really opens up a whole range of possibilities. But at the highest level, it's a formal acknowledgement by the US that Bitcoin is clearly an asset of strategic national importance. And the day after, the Office of the Comptroller of the Currency issued Interpretive Letter 1183, rescinding Interpretive Letter 1179, originally issued in 2021, which had mandated that the banks obtain supervisory non-objection before engaging in crypto asset activities. And essentially, Interpretive Letter 1183 reaffirms loud and clear that national banks and federal savings associations can engage in crypto custody without excessive prior approval and supervisory non-objection, and hold deposits backing stablecoins. So this is a major green light for the banks. And quickly, the new House and Senate leadership got to work on key committees, scheduling meetings to support the earlier executive orders from Trump. And in March, the Senate Banking Committee advanced the Genius Act, a stablecoin bill, in a strikingly bipartisan 18-6 vote, as well as a companion bill called the Stablecoin Trust Act, or HR 2392. And those bills, if passed, would designate the Federal Reserve and the Office of the Comptroller of the Currency, or the OCC, as the primary overseeing bodies for crypto and digital assets, and would impose requirements on reserves and consumer protections, among other things. Then 2 weeks later, the FDIC issued Financial Institution Letter 7/2025, rescinding another 2022 policy that had blatantly discouraged banks from engaging in cryptocurrency activities. And like the OCC's interpretive letter, the new directive from the FDIC makes it loud and clear that FDIC-supervised banks can engage in crypto-related activities without prior FDIC approval. And so, to be clear, this is a major regulatory shift, kind of reversing from a cautious, notify us before you do anything crypto stance adopted under the prior administration to a, yes, you can do this, go ahead stance. And in fact, the new FDIC acting chairman, Travis Hill, went out and explicitly stated that the FDIC is, and I quote, turning the page on the flawed approach of the past 3 years. So really seeing quite a turnaround across all the agencies in America. And just last week, President Trump signed the repeal of the IRS DeFi broker rule, TD 10021, which was kicked off initially by Senator Ted Cruz and Representative Mike Carey in January under the Congressional Review Act. But the rule, IRS DeFi broker rule TD 1021 or 10021, finalized by the IRS late last year, required DeFi platforms and certain wallet providers to act as brokers, mandating them to collect user information and issue tax form 1099s for tax reporting purposes, which is essentially an impossible compliance burden for a software protocol that is, by definition, not run by a central group or company that can collect this information, and even is often largely autonomous and run by anonymous users and code. And legal scholars at the time even warned it could be unconstitutional, as it would force surveillance without due process. So it has been a busy past few months in the US. And as you can see, just about every week, we've had a new key order, case dropped, regulatory win, new M&A announcement, or something major and positive for the industry. Canadian regulators, on the other hand, looking up to the north, spent much of last year tightening their regulations and cracking down further on crypto companies. And so as a result, they've seen the exodus of crypto exchanges like Binance, Gemini, and OKX continue into 2025, unfortunately. And in the US, as I mentioned, in addition to all the obvious regulatory progress, the anti-crypto army of Elizabeth Warren and Gary Gensler and Operation Choke Point 2.0, who were responsible for so many of those antiquated, stifling rules and damaging lawsuits, was systematically identified and in many cases terminated or reassigned to places where they could no longer damage American interest, and many resigned. And here you can see some of the highlights at each agency. And this is far from exhaustive. There were many, many more. But the most notable is probably the replacement of notorious anti-crypto SEC chairman Gary Gensler with decidedly pro-crypto chairman Paul Atkins, who sits on the advisory board of the world's leading tokenization company, along with our managing partner, Matthew. But really, at just about every agency, the SEC, CFTC, CFPB, OCC, U.S. Department of the Fed, the FDIC, across the board, we've seen entrenched anti-crypto interests essentially replaced with pro-innovation leaders who have clear mandates to make America the capital of crypto. And here you can see it in action. Immediately after Trump took office, he got to work right away. And as a result, the SEC has now dropped or quietly paused almost all of its cases, probes, and investigations into leading crypto firms. So Binance, OpenSea, Consensus, Uniswap, Ripple, Robinhood, the list goes really on and on. And there are also now a variety of task forces, committees, and working groups at almost all agencies and levels of government to advance crypto regulation. And in March, Trump held the White House's first inaugural crypto summit, bringing together leaders from the public and private sector to discuss scaling the U.S. crypto market. Also, following the establishment of the Federal Strategic Bitcoin Reserve and Stockpile, a whole host of U.S. states began to discuss and advance their own state-level Bitcoin Strategic Reserve bills, which you can see here. And in just a few short months, remember the U.S. only federally announced this a month and a week ago today, we already have 47 different strategic Bitcoin reserve bills introduced across 26 states. And again, you can download the full tracker on our website, so I won't hover here too long. But suffice to say, the Bitcoin reserve topic is no longer theoretical. The federal government is building it currently already, and the U.S. states are rushing to make their own too. And this forces other countries and governments to now ask the question, if Bitcoin is an asset of strategic national and global importance, can we really afford to be the last country building up our reserve? So all in all, it's been a really busy year in America, but we are quickly catching up in this race for the future of digital finance. Looking back across the pond, as it were, to Europe and the UK, it's been considerably less busy, but no less positive. Implementation of the EU's comprehensive markets in crypto asset regulation, or MiCAR regulatory framework, which has been underway for almost 3 years now, finished in December, and it's now fully live. In January, the HM Treasury issued a letter called the staking order, clarifying finally that qualifying crypto asset staking schemes are not collective investment schemes and do not trigger the complex web of regulations involved, which removed a lot of regulatory hurdles for staking. Shortly thereafter, the Financial Conduct Authority published discussion paper 24.4, which opened a formal crypto market rules consultation. And the following day, we saw the first crypto asset service provider license issued under MiCAR to legacy German exchange operator Horst Stuttgart's digital arm, and others are expected to follow shortly after. The conflict with Russia has also seen crypto become a pivotal lever, with the 16th EU sanctions package specifically targeting Russian crypto exchange Garantex. And this is the first time we've seen a sanction directly target a specific crypto company, and it worked. Garantex actually soon shuttered thereafter. Similarly, EU sanctions in March banned EU members from offering crypto custody or wallet products to Belarusian nationals, and even banned them from holding leadership jobs at crypto-related firms. So all in all, we saw Europe and the UK compound on the progress of MiCAR in Q1 and continue to work the work of wiping away all of the anti-crypto, anti-innovation policy to make room for digital asset leadership. And if you want to stay up to date, our London partner, Mitch, writes a letter from London regularly, which is really excellent. So you can sign up for that on our website if you haven't already. I read it almost every month. And here you can see this is the Financial Conduct Authority's actual crypto policy roadmap, just to get a sense. And you can find this online if you really want to read it in detail. I won't, but I thought it was worth flashing up just because right now, today, agencies and governments around the world are preparing and acting on documents just like this. Further to the east in Asia, China, as I said, remains fairly anti-decentralized crypto, and they continue to tighten restrictions, including expanding their Forex rules in January, really as a basis to cut off more crypto trading in the retail. But China's central bank digital currency, the digital yuan, on the flip side, is arguably the world's most advanced and certainly the world's most implemented. Excluding mainland China, however, the regulatory progress really continued apace in Q1. The Thai SEC is reviewing Bitcoin ETF proposals, and they issued new guidance in January to allow ultra high net worth investor funds, mutual funds, to invest up to 20% of the net asset value in crypto and even 5% for retail funds. Hong Kong Security and Futures Commission announced an even more streamlined fast track program for its new virtual asset transaction providers licenses, and they issued their 10th crypto exchange license in February, following a further expansion of the trading and custody rules. South Korea is opening its crypto pilot program now to institutions, and in March they announced they would further delay capital gains on crypto 2 more years to 2027, really as a clear effort to incentivize crypto investment. So mainland China, the crypto regulatory landscape continued to improve in Q1 in Asia, and all sorts of pilot programs and licensure regimes are really blossoming into a very vibrant digital asset ecosystem. And our head of Asia writes a monthly letter from Hong Kong, by the way. If you haven't seen it, it's really worth checking out. So you can check that out on our website as well. And moving over to India and Russia, in India and Russia, it's been considerably less favorable, although there is moderate clarity in the stringent regulations that are in place, at least for the moment. And both countries are actively advancing their central bank digital currencies. In August 2024, President Vladimir Putin signed a law that came into effect actually at year end, officially legalizing crypto mining in Russia, but subject to strict regulations, central bank oversight, and an accompanying taxation scheme. So essentially, it's fairly stringent still, but it did mark a bit of a softening after years of outright crypto hostility. However, Russia also participated in conversations last year with non-BRICS nations about fostering non-USD stablecoins, particularly as a way to combat the growth of US dollar hegemony. And in March, the EU sanctions I discussed earlier, along with a freeze of Tether stablecoins on Russian exchanges and platforms, led to the closure of Russian exchange Garantex. So effectively, crypto policy is quickly making its way into trade policy and geopolitics, something we've been expecting for years. Also in March, the Bank of Russia proposed legislation about limiting crypto trading to wealthy individuals, but it was really a de facto ban on retail crypto trading for the most part. And interestingly, following the US Strategic Bitcoin Reserve and Digital Asset Stockpile news on March 6th, just 2 weeks later, a Russian civic chamber member suggested creating a state-run fund in Russia for seized crypto assets, essentially kickstarting a reserve in much the same way the US is doing. Looking at India, it's also been similarly anti-crypto in the past few years, but things do seem to be softening. We've already seen policy changes discussed at the federal level in response to the US's rapid reversal in sentiment, and the digital rupee pilot was expanded in February to include its first non-bank app, Fred, and it looks like Coinbase may finally also re-enter India after canceling plans and failing to do so in previous years. And last but not least, the UAE and Dubai, which marks one of the world's most comprehensive and advanced regulatory sandboxes by far. There are already multiple crypto-specific regulatory bodies in the UAE across different zones and nationally. And in fact, the UAE actually accomplished much of this last year and the year before, and was one of the earliest leaders in this regard. So the news in Q1 in the UAE is mostly that they continue to actively rise up and embrace digital technologies. We saw Dubai's first fully licensed exchange launch by Deribit, which subsequently moved all of their global operations to the UAE in January. We saw Dubai's Financial Services Authority approve their first regulated stablecoins and grant their first major payments license to Ripple. The Virtual Asset Regulatory Authority in Dubai granted its first major derivatives license to Crypto.com in March. And shortly thereafter, the central bank confirmed the digital dirham, the central bank digital currency rollout is set for Q4. So all in all, what is the overall status of digital asset regulation globally? Digital asset regulation has entered a heightened acceleration phase around the world. Today, nearly all geographies have drafted, approved, or implemented regulatory regimes, and some have gone even further. Many are also doing the hard work of wiping away prior era policies which were anti-innovation, and in some cases, even illegal. And most notably, the rapid reversal in US crypto sentiment and newfound administrative support is already driving global urgency to compete for digital finance innovation. And as the world's largest and most important innovation economy puts regulatory structure in place, the rest of the world will move to harmonize theirs in order to capitalize on US markets. So what should investors expect heading into the second half of 2025 and beyond? Well, globally, we can expect capital markets to begin to reset, and that capital will start to flow more easily toward innovation like it ought to. As a result of the US wiping the hostile slate clean, they'll also see a potential onshoring of Web3 talent back to the US, and may see the redomiciling of companies, possibly even crypto treasuries back to the US. Users can also finally begin to use and try these new innovative technologies without worrying that their government is going to come down on them for essentially embracing innovation. US banks, asset managers, and payment firms will move very quickly to catch up, creating exit opportunities globally. It's very rare here in this technology that they're all effectively 5 to 10 years behind. In private markets, international capital can now find its way into the US private sector innovation more easily, and we expect to see a similar surge in core infrastructure investment and early and late stage venture activity. Similarly, in public markets, we expect to see a string of blockchain go public events, really marquee and blockbuster IPOs and de-SPAC events, because there's a slew of mature late stage assets which have been effectively sidelined from public markets until now. And just like in the private markets, we can also expect to see increased M&A activity, partnerships, and JVs, and so on, as US legacy financial institutions rush to catch up and establish dominance in this technology in which they're uniquely 5 to 10 years behind. So what just happened in Q1 all in? At the highest level, our investment thesis is proving more true than ever. Blockchain is now at an inflection point, and digital finance is inevitable. This has been the busiest and most positive period in the history of the industry, and the world's governments are now vying to put regulatory frameworks in place and become leaders in digital finance. Larry Fink, BlackRock CEO, even discussed tokenization's critical role in driving the next decade of returns in his recent annual chairman's letter. Yet, if you invest now, you are still early. In fact, more than 5 billion people still don't own any crypto. And as you can tell, half the world's governments are still rushing to get this in place. But you won't be early for long if these report results tell us anything. So if you are interested in learning more or chatting with our investment team, please shoot us an email at ir@blockchaincoinvestors.com. We really do believe this is an opportune time to deploy capital ahead of the transition to digital finance. And on that note, I will close down this webinar. thank you all for joining this year-end edition of our biannual digital asset regulation report. And I hope to see you again shortly in July for the release of our mid-year 2025 edition of Meet the Blockchain Unicorns report, because there will be a whole host of new unicorns to share. Thank you.